Welcome to The Explainer. Today, we're going to break down something that feels distant but isn't. How a conflict, maybe thousands of miles away, can actually hit your wallet, hard. It's like this massive economic domino effect, and trust me, it reaches everyone.
So here's the plan. We're going to follow this chain of events, step by step. We'll start with that one single spark, right? A geopolitical event. And we'll trace its path all the way through oil prices, inflation, interest rates, and finally into big investment markets like gold.
I know, it sounds kind of disconnected, doesn't it? Like, how can a war overseas really change the price of my groceries? Well, stick with me, because by the end of this, you're going to see exactly how those dots connect. A straight line from the front lines right to the checkout line. All right, let's get into it.
Okay, so every big economic story has to start somewhere, right? There's always that one moment that kicks everything off. And in our case, it's that very first domino, a geopolitical shock that sends the first powerful ripple across the globe.
And this happens fast. I mean, almost instantly. Just picture it. A conflict breaks out in a big oil-producing region. Suddenly, nobody knows if that supply is stable anymore. And that uncertainty alone can make crude oil prices leap. I'm talking from maybe $80 to over $100 a barrel, practically overnight. And that's just the first domino to fall. Now let's see how this shockwave starts to spread. Right, so that first shock to oil prices, it doesn't just stay put. No way. It escapes, and it kicks off this powerful chain reaction, one that leads directly to something we all feel every single day: inflation.
So what is inflation really? In the simplest terms, it means your money is losing its punch. That $100 bill in your wallet, it buys you less today than it did last year, and it's going to buy even less next year. It's a silent thief, really.
And here's where you can really see that domino effect in action. Think about it. A spike in oil, just one thing, makes it more expensive to transport goods, to run factories, to manufacture, well, everything. And businesses, they're not just going to eat that cost. They pass it right along to us, the consumers.
Okay, so prices are going up, things are getting kind of crazy. What happens next? Well, this is when the central banks step in. They've got one really powerful tool they use to try and get things back under control.
Yeah, think of it like they're tapping the brakes on the entire economy. The whole point is to slow down spending, reduce demand, and hopefully, just hopefully, bring that runaway inflation back down to earth. But, and this is a big but, hitting the brakes has other consequences, especially for the bond market.
Okay, now this is where things get really interesting. There's this crucial relationship, kind of like a seesaw. Let me break it down. Say you own a bond, and it pays you a steady 2% interest. Pretty good. But then, whoops, the central bank raises interest rates. Now new bonds are being sold that pay 4%. So my question to you is, why on earth would anyone buy your old 2% bond when they can get a new one for 4%? The answer is they won't, not unless you sell your bond at a discount. And that's exactly why the value of those older, lower-rate bonds goes down.
And it doesn't stop with bonds. Oh no. These interest rate changes send out these huge, unpredictable ripples, and they spread right into the giant ocean of global currencies. I mean, look at the United States. It's a perfect real-world example of this exact chain of events playing out. They had high inflation, so they were forced to jack up interest rates pretty aggressively. And what happened? It created all this volatility and is now raising some really serious questions about the country's long-term economic health.
So this whole thing has a name. It's called currency depreciation. It's pretty simple, really. When any country has high inflation and its economy looks shaky, the value of its money, its buying power on the world stage, can take a nosedive. And this leads to one of the biggest, most debated questions in finance right now. It just goes to show you how that one little spark we started with can have these unbelievably far-reaching consequences. I mean, we're talking about something that could potentially reshape the entire global financial system.
So, let's connect the dots here. We've got bonds looking shaky, currencies are unpredictable. What do you think happens when investors see all this? They get nervous, really nervous, and they start searching for somewhere safe to put their money, somewhere they see as stable and reliable.
You know, there's a saying, in times of widespread uncertainty, investors don't just seek profit, they seek preservation of capital. And that just nails it, right? The game changes. It's not about getting rich anymore, it's about not losing what you have. And that fundamental fear, it pushes a lot of people toward one classic safe haven that's been trusted for, well, centuries.
And you can see it right here. This chart lays it out perfectly. When do people get most interested in gold? Well, look at the bars. During times of economic uncertainty and especially high inflation.
Exactly the dominoes we've seen fall. Interest in gold shoots way up. It's almost like a reflex action to all the chaos. And there you have it. That's the final piece of the puzzle. When faith in things like paper money and government bonds starts to crumble, where do people run? They often run to something they can see and touch, something with a perceived safety and security. They run to gold. All right, let's run through that whole domino chain one last time, from start to finish. A war kicks things off, spiking oil prices. That spark lights the fire of inflation. To fight the fire, central banks hike interest rates. Those higher rates knock over the bond and currency markets. And all that uncertainty and fear sends investors running for a safe haven, like gold. See? One thing leads to another, to another.
So, the big question is, in a world where all these dominoes are falling, where do you find your stability? Well, understanding this whole chain reaction, from that very first push to the last domino falling, that's the absolute first step to figuring out the answer.